Good morning. My name's Paul Nicol, Managing Partner of GFM Wealth Advisory. A warm welcome to our GFM clients and guests joining us this morning for an update on one of our favourite listed investment companies, WAM Microcap. We're absolutely thrilled to have Oscar Oberg, the lead portfolio manager of several of the Wilson Asset Management listed investment companies, and Tobias Yao, who is a portfolio at WAM, joining us this morning. I'll formally introduce Oscar and Tobias in a moment. As incredible as it seems, we're now nearing the end of 2020. This is our last webinar for the year, and as a business, we're particularly proud during a very difficult year of 2020 that we've stayed in constant touch with our clients, firstly checking on the welfare of our clients, but also just as importantly, keeping all of our clients as investors up to date with what's been happening during this tumultuous period for markets in 2020. Our webinars have proved extremely popular. We get terrific feedback after our webinars on running these events. So we're thrilled our clients have enjoyed these throughout the year and that we've been able to give you as much information as possible as to what's been happening. Fortunately, as the year's ending, the COVID environment has improved dramatically. So particularly for our Melbourne-based clients, and we're a Melbourne-based firm, it's going to be nice to have a COVID normal Christmas where we're able to spend time with our loved ones, our friends, our family and the like, and enjoy a normal period after a considerable period of lockdown. We're really looking forward to 2021, being able to get in front of our clients again face to face, and we're also busily preparing to run face-to-face events into next year. So fingers crossed the environment continues to remain the way it is now. So an area of investment markets that we've long been an advocate for investing is in Australian microcap companies. We're attracted to investing in microcap for the potential lucrative returns of investing in microcaps, an area of the market that is often not largely explored, where companies have potentially great earnings profiles or potentially are mispriced. But if I had $1 for every time a client or a friend or a family member offered me a hot tip in the microcap space and I invested that, sadly, I'd be broke. We're a big advocate for using professionals in this area because we see a lot of investors get their fingers burnt when investing in microcaps. So we're a strong supporter of WAM and of the microcap strategy because these guys understand that segment of the market and are able to uncover the gems when investing in this area. Now, before I get underway, it's important that I explain, as I do through all of these webinars, that the information that we're going to give you today is general in nature. We're going to talk about specific stocks. The guys from WAM are going to talk about their microcap strategy, but this is general advice. It's not specific in nature. It's designed to give you information. If you have more particular queries relating to your personal situation, we ask that you get in contact with our office and speak with one of our advisors. Now, may I also say, when I was talking about the WAM Microcap strategy, the guys are going to talk about this a lot more, but they got underway in June of 2017. And since that point in time, they've averaged a return of 21.3% per annum. So they certainly know what they're doing. So let me formally introduce Oscar and Tobias. So Oscar has more than 13 years experience in financial markets. Before joining Wilson Asset Management, Oscar worked on the sell side as an analyst at CLSA and 3 years at Grant Thornton working in transaction advisory services. Oscar's the lead portfolio manager for several of the WAM vehicles, including WAM Capital, WAM Active, WAM Microcap, which we're talking about today, and WAM Research. And Tobias has 12 years experience in investment markets. Prior to joining Wilson Asset Management, Tobias spent 5 years as investment analyst at Pengana Capital, and he worked at Ernst & Young in the transaction advisory services division. Tobias is now a portfolio for Wilson Asset Management as well. So firstly, good morning, Oscar.
Yeah, thanks, Paul, and the team at GFM. Really appreciate the chance to be on today, and thanks to all the clients for dialing in. Really appreciate it.
Terrific. And morning, Tobias. How are you?
Morning, Paul. How's it going? Good.
Yeah, terrific. So look, I think what I'll do, Oscar, is I'll start with you first and foremost, if that's okay. May I please start by could you give us a rundown on who Wilson Asset Management is and what it is that you do?
Yeah, thanks, Paul. Again, no, I really appreciate everyone being on here. So Wilson Asset Management was set up back in 1997 by our founder, Jeff Wilson. We focus on undervalued growth companies, which is the history of the business was largely in the small and microcap sector through the first fund that was WAM Capital that you see sort of in the top left of the slide that's on the screen. The business has built over time, has grown, and we now have 7 listed investment companies that all trade on the ASX. It totals around $3.5 billion of funds under management. And Tobias and I, with a team of 5 other guys, we run 4 of these 7 funds. So as Paul said, that's WAM Capital, WAM Research, WAM Active, and WAM Microcap. So that's around $2 billion of funds under management. And as you can see, the WAM Microcap, which is in the bottom left corner, is just over $300 million in size. In terms of how we look at stocks at Wilson Asset Management, every fund is run the same way. So broadly speaking, we have an investment process that's split 50-50 between long-term research ideas and then also shorter-term, let's call it market-driven or active ideas. And that's generally how the funds are made up. Now, the most important thing at Wilson Asset Management across all the funds is that we won't invest in a company unless we see a catalyst. And a catalyst is something that, might lead to the share price increasing or re-rating, as we call it, to a higher valuation over time. So that might be an earnings accretive acquisition, a divestment, could be an earnings upgrade or earnings being higher than what analysts are thinking for a particular company, something that changes the perception of the company going forward. And if I look at sort of WAM Microcap specifically, if you have a look just in the bottom left corner, I think you can see sort of the net tangible assets is around $1.44 versus the share price at $1.61.5. I think that's a really important thing for people looking at listed investment companies to first look at, because what you can see there is we're trading at a slight premium, around 12% to what our assets are that we manage. Now, there's a variety of reasons behind that. The most important of which we think is our ability to pay fully franked dividends. And if you have a look at the bottom of that, table, you can see the profit reserve. It's sort of over 26 cents a share. So last year, if we exclude the special dividend that we paid an interim and a fully franked dividend of around 6 cents a share. So it's basically showing that we have around just over 4 years of dividends that we can pay based on the current profits of the listed investment company. So I think that's worthwhile talking about that, because there's a variety of funds such as like WAM Capital that trades at a large premium to its net tangible assets, or WAM Global that trades at a slight discount at its net tangible assets.
Yeah, well, this is fascinating, Oscar, because as you know, there's been a lot of talk in the last couple of years about listed investment companies. So you've spoken about the dividends as one of the potential advantages of being in a listed investment company. What are some of the other advantages of investing via a listed investment company structure? And do you guys at Wilson Asset Management think like you have a competitive advantage in this area?
Yeah, I think there's a variety of ways I can answer the question, but I think the main one is that running a listed investment company gives you the ability to look through the cycle. And I'll give you an example of this. So say when equities, like we're seeing right now, it feels like there's a lot of money flowing from, say, bonds into equities. Now, if we were an open-ended fund, right, so like some of the other funds we compete against, where they're getting money from some of the superannuation funds, they're probably receiving quite a lot of inflows of equities, just as I guess the makeup of, say, our portfolios within our super changes to a higher weighting of equities. Now, what that means is they're forced to invest in the market at the top of the cycle. Now, for us, taking a long-term view, we're doing this at the moment, we're actually selling into this strength. Now, if we look at the reverse, if we go back to COVID in March, you had periods there where, obviously things were very, very tough. If some of the institutional clients, like a superannuation fund, says, "Oh, I don't want too much equities, I've got more cash," they pull out their equities, and you see redemptions from some of the open-ended funds. They're forced to sell in the market. Now, what we were lucky enough to do at Wilson Asset Management back in COVID was we actually bought quite a lot of companies around sort of March and April. So I think for the listed investment company, because our capital is fixed, it's a closed-end fund. When we first have our initial public offering, it does give us the ability to invest through the cycle. And if I look at Wilson Asset Management, we have just over 85,000 retail shareholders. We've been doing this for a long time. We do have a lot of faith in terms of the performance, but we treat our shareholders with respect. We have 5-person strong communications team, speaking to our investors all the time. So that, I think that's, a testament to Jeff and the management team here, because we're always focused on effectively communication and treating shareholders with respect. If I sort of think about the competitive advantage, and probably speaking too long, but of Wilson Asset Management, forgetting the listed investment companies, but just thinking of our business. If you go back to the previous slide where I showed you all those 7 funds, that's from microcaps, which we're talking about today, to small caps with WAM Capital, WAM Research, WAM Active, to large caps with WAM Leaders, and global equities with WAM Global. And now we've added the WAM Alternatives, which is sort of a private company sort of focused business. Now, there's a lot of information sharing across that whole wide range of funds. And, we'll talk about a number of companies today within the WAM Microcap Fund that were actually previously large cap companies. So that information sharing across all those funds is a huge competitive advantage. And then added that to the scale that we have means that we have the ability to get decent allocations in, say, placements and IPOs from some of the brokers that we're speaking to. So long-winded way to answer it, Paul, but hopefully that gives the callers a sense of what we think are competitive advantages.
Terrific, Oscar. So Tobias, I'll bring you in. So as I alluded before, the microcap listed investment company started in 2017. So what opportunity did Wilson Asset Management see in microcaps to start the listed investment company in 2017?
Yeah, thanks, Paul. So I think at the time we had very strong interest from our existing shareholders to create a product. And we believed as a team we could generate very strong returns for our shareholders by applying the WAM investment process to the small end of town. The microcap market is historically under-researched by the sell-side analysts, and therefore it gives us the opportunity to find these hidden gems and invest in these growth businesses early on in their journey. Individually, we probably do over 1,000 meetings a year, with suppliers, companies, customers, industry experts. And through those meetings and the on-the-ground research, we often find a lot of interesting companies that's overlooked for whatever reason. Now, we could also leverage the existing relationships which we have with our broker network to help us generate ideas, but also more importantly, sort of participating in some of the capital raises in the space. And I think finally, from memory, during that period, many of our peers have been very successful in raising capital. So a lot of their funds got larger, and as a result, they started to gravitate towards some of the larger companies, again, leaving a gap in the microcap space for us.
So it sounds like there's tremendous opportunity in this space. Oscar, I'll throw it over to you again. So what is the definition of a microcap company on the stock exchange? Is that the size of the company?
Yeah, look, I wouldn't say there's a set definition. I think there's a universal sort of, let's call it a rule, or like how people think about it. And that's sort of the way we look at it. And it's a company sort of less than 300 mil in terms of market capitalization. That's on a free float basis. So I'll give you an example of a company like, say, 7 West Media, which is a media company, 7 Network, obviously. That's a company that's sort of around, I think, 500 million market cap off the top of my head. But it has sort of 40% of the free float tied up within 7 Group or Kerry Stokes. So that would actually fit a less than 300 mil market capitalization and fit within, I guess, the sphere of companies that we look at. I think one thing to point out in terms of going back to what Tobias has said, it's definitely the under-researched part of the market, and that is definitely the competitive advantage. If I give you an example, 7 West Media, that was a large cap company. So when it fell out of favour, and so look, it used to be well researched. People used to care about it. Now it gets stuck in micro caps. It's so small that everyone forgets about it. So going back to our competitive advantage, that stock used to be in our WAM Capital portfolio 3 years ago. So we do have an inbuilt knowledge of it. So when it comes back into micro caps, we do the work on it. And then when we do sense that things are turning, that's a signal for us to buy the stock. So I thought that would give a bit of flavour, early on in the conversation, sort of how we think about stocks in the microcap space.
So Tobias, it's a big universe, the microcap universe. I may be mistaken, but I think there's like over 1,800, 1,900 companies that fit sort of outside the top 300 on the stock exchange. So what's the investment selection process? How do you guys at WAM go about identifying which companies that you want to invest in?
Yeah, so the investment selection process is actually the same that we apply across all the stocks, from the smaller to the larger companies across WAM Microcap and WAM Capital, for companies that suit our longer term research process. So these are companies we're happy to hold over a 3 to 5 year time horizon. What we need to see is an undervalued growth company. So in this case, a growth rate that is higher than the current valuation. We need to do a lot of on the ground research. We have a proprietary rating methodology which we apply. And we obviously have to assess, the management team and the industry structure for many of these companies. Once we're satisfied that we're happy to invest in these businesses, we need to see a catalyst that could re-rate the share price over time, and that's when we invest on the research side. The other part of the portfolio is sort of an active or market-driven strategy. In this case, all we need is a catalyst that we believe will re-rate the share price. Now, a catalyst could be a divestment, an EPS accretive acquisition, capital management, cost out, contract awards. So there's a few things that we believe the market is not currently pricing in, that once the news comes out, the share price would go up.
So fascinatingly to me, Oscar, despite the COVID environment of 2020, we're seeing currently an extremely strong environment of returns in the microcap space of the ASX. Why is that the case?
Yeah, Paul, we're surprised too. I wouldn't say, like, if you asked me back then in March and April, I was in no chance at all. And we were preparing for that. I mean, we went, and I should have said one of the competitive advantages before, like, we have a flexible cash mandate. And so when times got tough, and if you remember, late February, early March, we did take the decision to sort of liquidate the portfolio, and in particular some stocks exposed in some heavily impacted COVID-19 sectors, so such as tourism or property. So we went to 40% cash. So that was sort of how we were thinking about microcaps. And I remember talking to Tobias, I was like, oh God, like, when we get out of this, it'll be all the large caps that'll be rallying, and, poor old microcaps will be left behind. But it hasn't happened that way. Look, I put it down to a few reasons. I think the first one, I think there's been a whole new investor base that has come to the market particularly over COVID. And I think it's the younger generation, and that they are looking for companies, they probably have a higher risk tolerance than perhaps even our generation, of our generation, certainly my parents' generation. But I think, we've seen that with a number of companies. Some of the technology companies do incredibly well. I think that's another reason you do see a lot of these technology companies in the microcap sector at an early phase. And I think the feeling is, these businesses, given the competitors or the comparable companies overseas, such as Amazon, Facebook, etc. So everyone's trying to find that next, let's call it afterpay, in the Australian market. So you do see a number of these small technology companies with a huge growth profile coming through in the microcap space. I think as well, interest rates is a huge reason. And if I look at sort of the companies we look at in microcap, a lot of them are very acquisitive and are acquiring other companies. And we look at the current state of the market that we're in now, it's a huge advantage to have equity, to be listed and have capital basically at your call to make acquisitions. And with 0% interest rates, effectively, they're always going to be accretive to your earnings and add to your current earnings. So we do expect quite a lot of acquisition activity going forward in the microcap space. And I think that's some of the reasons why they've done well. And to Tobias's early question, I always go back to it. It is an under-researched part of the market. And you find companies that used to be researched become under-researched. So it does create a huge opportunity for you to find, those companies on their early phase.
Well, there have been a lot of thematics in investment markets that have evolved during 2020 COVID. And I think one of the really obvious ones was e-commerce. So Tobias, I'm really interested in your views on this. I know that the WAM Microcap WAM Microcap has been invested in a couple of the e-commerce stocks. But now that it seems as though we're getting closer to a vaccine, what's your view on e-commerce going forward?
Yeah, that's a great question. Thanks. Look, we've done exceptionally well with many of our e-commerce names, but I think over the last couple of months, we have significantly reduced our e-commerce exposure and have taken profits. In hindsight, we probably could have gone harder and earlier. The e-commerce companies, as you've mentioned, have done really well. Since the news of the vaccine, the whole sector has had a sharp correction, and they've rotated away to cyclical and value companies. Our view is that there is no doubt that the structural shift in terms of the dollars moving to the online channel is here to stay, and this theme is going to play out in the medium to the long term. The key for us is to be very selective in the companies that we back. So someone like Temple & Webster that we've talked about in the past, they were growing at 50% in a pre-COVID environment, which is a strong signal to us that in a post-COVID environment they could continue to maintain those levels of growth. In the short term, however, the market is quite worried about the ability for these companies to generate, positive revenue growth on top of what was a really strong June quarter this year, where a lot of these companies were growing, over 100%, and it was aided by the lockdowns and the social distancing. So potentially these companies could continue to drift for the next few months until we start to see the first signs that certain companies can actually comp those growth numbers. So we will be monitoring all the indicators very closely over the next few months to determine where to sort of increase our bets.
And retail, I find this fascinating. There have been quite a few retail stocks which have performed incredibly well in this period. So what's the view on retail, Tobias?
Yeah, it's quite interesting. So in the retail sector, since the announcement of the vaccine, it switched quite aggressively from the COVID beneficiaries or companies that benefited from the lockdowns, such as the online players or players in the homewares and furniture space, to now the incremental investment dollar is going into the reopening beneficiaries, where typically these are brick and mortar retailers where they were negatively impacted by the lockdowns and they couldn't open up their stores. We think this theme is here to stay over the next few months. Given the reopening beneficiaries will continue to enjoy the earnings momentum, given the starting base is very low from an earnings perspective. In terms of some of the companies that we like in the portfolio, there's a couple of recent IPOs. One is called Dusk, which has a store network which sells scented candles and diffusers. And another one is called a Universal Store, which has a store network that effectively sells apparel to teenagers and young adults. And these millennials have a lot of disposable income from their parents.
So, Oscar, another theme that I'm really interested in is we're seeing that governments have a particular propensity at the moment to want to spend money on infrastructure, okay? So when I think in the microcap space, I'm thinking mining, services businesses and the like. So how do you view this area of the market?
Yeah, I think very positive. I think, we always make mistakes too. And I think our mistake was, if we go back 6 weeks ago, we didn't have enough of these stocks in the portfolio. And it is certainly a sector we know very, very well. So it was a little bit disappointing in that regard. But look, we've acted quickly. And I think some of the companies that we like, because you're right, because you look at sort of iron ore prices, close to $150 a ton. BHP, Rio and Fortescue are making so much money. It's ridiculous at that price. So they do have a propensity to spend, and they've all got depleting reserves that they need to replace at a given point. So this is usually a very good environment for mining services. And you've also got gold prices that are at record highs. Coupled with that, you look at the state and federal governments, go back to the budget. The amount of stimulus that they've provided there is much, much higher than what it was back at the global financial crisis back in 2009. So, I think one of the interesting things on the infrastructure space is, if you look at it over the last few years, we've had record levels of infrastructure anyway, but it's been very hard to make money for the companies listed on the ASX. And I think the feeling we're getting when we're speaking to a few companies out there is that the government is becoming a little bit more, how can I say, it's a little bit more accommodating, and realises that they need to get these projects underway, and they need engineering companies and housing companies to make money, to effectively employ a huge proportion of Australia's workforce. So, look, companies we quite like at the moment, we like SRG, which is a mining services contract. It's on a price earnings multiple valuation of 7 times earnings, very cheap. Like Macca, and that, again, another contract miner based in Western Australia, focused in gold. Like Mitchell Services, which is a drilling contractor based in coke and coal and also gold markets. And we like labour hire companies as well. So People Infrastructure is a very big weighting in the portfolio, which is very much exposed to construction. And then also Mader Group back in Western Australia. So we've got a number of exposures there in the portfolio now. So quite positive on that sector going forward, given very cheap and attractive valuations.
So I have to bring up technology. Everybody wants to be invested in technology at the moment, and I imagine this is a big part of your investable universe. So I'm keen on, WAM Microcap, its exposure to technology, and the question we frequently get asked is about the buy now, the pay later companies that are listed on the ASX. I'm keen to get a little bit of a house view on those as well.
Yep. So the tech space has had a very strong run for a very long time. We still believe that for many of these higher quality companies, they can continue to disrupt the markets they're in and grow in those respective markets. However, the valuation for some of these companies do look quite extreme. Too often, we see companies on 100 times sales multiples in the space, which we tend to avoid. Our bread and butter is finding technology companies that's valued like an industrial company, so profitable businesses. That's on a PE ratio, or finding technology companies that's exhibiting an accelerating growth profile. So the growth rate is increasing. We think these type of companies gives us the best risk-adjusted returns. In terms of the buy now, pay later space, the valuation is very high for many of these companies trying to be the next Afterpay. Our view is that over time, there needs to be a rationalization of the space. There are way too many players, and most of them will be growth constrained at some point in the future. So for us to be excited about some of these names, we have to have a very strong view that the unit economics, and the loss ratios, will continue to improve over the next 2 to 3 years, and the growth rate should either stabilize at the existing sort of high growth rate or even accelerate. So it's a very high hurdle. This is purely, I think, because with a high valuation, it doesn't really give you the same level of margin of safety that you typically get with many of the other companies. So you do need flawless execution by the management team.
So Oscar, we've got the slide up here. Some of the other sectors of the market that you wouldn't mind talking about for a minute or two that appeal to WAM?
Yeah, I think, look, what we've seen in the last 6 weeks with the share market has been a monumental shift in how people think. Just like coronavirus was back in March. And, I think I mentioned before, like mistake we made in the portfolio was we probably didn't have enough companies exposed to the mining sector, which has done very well in this time. But one sector that we did have quite a decent exposure on, and we're actually very positive going forward, is the traditional media sector. Now, if you have a look at this sector, I mean, these companies were a lot bigger than what they used to be. A lot smaller than what they used to be. They've really struggled as advertising has shifted to online, such as Google and Facebook. And you will probably not get a worse sector that was impacted through the coronavirus outbreak, because effectively there was all this uncertainty, and large companies that advertise a lot just basically pulled their advertising and their discretionary expenditure. And you take one level as well. People weren't driving, people weren't outside. So outdoor media companies, for instance, they got even more hurt, and radio companies got even more hurt. And I think the interesting dynamic there was, if we go back to April and May, all these companies were preparing for the worst scenario. So they were taking a lot of costs out of their business. And then, of course, Australia's done a fantastic job. Obviously feel for everyone in Melbourne. We've been lucky in Sydney. But clearly relative to the rest of the world, we've done a great job. So I guess these companies are now, they've done quite well, particularly since the vaccine announcement. But if you think about it, over the next 12 months, they've got a cost base that is down a lot. You've got a lot of companies now getting more confident and starting to advertise more. You got more people out and about. Maybe it's driving on a holiday. Doing more things outside. So companies such as Here, There and Everywhere, which is a 106.5, I guess, radio station in Sydney, we quite like, which is the old APN News and Media. It's one of our larger positions. Seven West Media I've mentioned before, which is, of course, the Seven Network. And we also like GTN, which effectively flies helicopters around telling you what the traffic report is, which, if you can remember, Vic LaRusso. So that's they're three stocks that we quite like there. And I think if we go back and earlier in the conversation, I talked about companies that have, we used to be large cap companies that are now micro cap companies. A stock we like, for instance, is Estia Health, which is aged care. Now, you couldn't actually, that's probably the sector that's been hit the most out of coronavirus. So that's a stock we're currently in, taking very much a long-term view. We think the government's going to come out potentially for some more funding into the sector, which would be highly positive, because there is a need for the sector. It's very, very important, which they'll be a beneficiary. So, I would say sort of, if I had to, a theme that is in the portfolio, it's trying to find those deep cyclical companies in really tough sectors that does feel they have a very good period. They can have a very good period over the next 6 to 12 months as we all get out and about and confidence increases.
Fascinating. So, Oscar, I've brought up the slide of what are the top 20 holdings in WAM Microcap at the moment. I'm really fascinated. One of your big holdings, and you've referenced it a couple of times, is Seven West Media. Can you spend a couple more minutes explaining why that's a company that appeals to you at the moment?
Well, we love companies like this. So if you have a look at the share price of Seven West Media, it has honestly been a dog, and it still is. For a long, long time. So I think we started buying it around 12 or 13 cents a share. And I guess it's a very simple thesis. I mean, so I sort of basically told you most of the thesis before, is that they've taken out a lot of cost. You're now getting more people advertising. So, over the next, say, 12 months, you should see actually quite strong operating leverage come through to the earnings line. And it's a company no one cares about. So there's hardly any analysts that follow it. They've assumed it's terrible for a very long time. They do have a bad balance sheet, but one of the reasons why we got into the stock was they have a new CEO called James Warburton, who used to run APN Outdoor, which was a company we owned in WAM Capital in the small and mid cap fund. And James was actually instrumental in selling APN Outdoor to JC2Co, which is the largest outdoor media company in the world. So he joined Seven West Media. He's embarked on a series of asset sales to try and reduce their net debt. And we know him quite well, and we're backing him to do that. And then at the same time, he got earnings recovering. So it's quite a nice story for us. And the best part about it is no one's talking about it. And the valuation, if we compare it to Channel 9, Channel 9 at the moment is currently trading at a price earnings multiple valuation of 20 times earnings. Seven West Media is on a price earnings multiple valuation of 6. So we see a number of catalysts. And if you think about our investment process, our first catalyst is earnings upgrades versus the analysts that cover the stock. Second catalyst is divestments to improve the balance sheet. So that's sort of how we see things playing out for that company. And I don't think it's on here, but it would have been just below the top 20 back in October. It's well and truly in the top 5, I think, right now.
Tobias, can I ask you about one of the high conviction positions in WAM Microcap, Infomedia? So who are Infomedia, and why is WAM Microcap strongly invested in Infomedia?
Yeah, so Infomedia is actually not a media company. Contrary to the name, it's actually a global software company that's trading on very attractive valuations. It's highly profitable and has $100 million of net cash on the balance sheet, ready to be deployed into acquisitions. So they provide a software solution for car dealerships and manufacturers globally for parts and services, which we think is an area where all their clients is investing in. the business has been impacted by COVID in terms of driving new business wins, but we expect the vaccine to be positive for Infomedia over the coming 12 to 18 months as their sales pipeline gets rebuilt. Going to my previous point, we're trying to find high quality technology companies and not paying too much for it. And this is one, and this is why we have a very large position in this business.
And Oscar, again, we've got the top 20 up here, and you've referenced a lot of the names there, and I think a lot of the names there would also be familiar to our clients. But I'm really interested in Viva Leisure. So again, who is Viva Leisure, and why is that a strong position in WAM Microcap?
Yeah, so again, we like companies like this. And now I'm a country boy, so I am a sucker for any company that comes outside of Sydney and Melbourne. And I'm from a town near near Canberra called Yass. And this is a company that came to us from a stockbroker about 2 years ago. And effectively, it was the largest gym company in the ACT. And I think it was a great IPO because everyone just hates gym businesses because they don't have a good track record. Fitness First has done very badly in Australia. But these guys have something different, and it's all based around technology. It's all based around an app. So if you're basically at a gym, say in a suburb in Canberra, you can look up the app. You can see there's people working out and all these different machines that you like to work out. There might be a line. You go, oh, okay, I don't want to go there. I'll check the nearby gym, and then you can see that it's empty. So you go to that one. So they've invested a lot in technology. Now, basically what's happened, and COVID is probably the best thing that's ever happened to them, right? I mean, if you look at their share price, it got smashed, right? Because no one's going to the gym. But what's happened now is there's no consolidator in the market to buy gyms, and they can literally, I think their earnings multiple or price earnings multiple might be around 15 times earnings, but they could be able to buy these gyms at sort of 6 times earnings. So the arbitrage on that is huge, and means they're paying nothing for these companies. So as I said before, key theme that we think will occur in 2021 is record low interest rates. Companies that have equity markets behind them have the ability to keep raising capital and keep acquiring. So, while it's easy to poke your nose and be negative on a gym business, we think this business could get very, very big and very, very quickly. And to put it in perspective, they came out a month ago. They've currently got 100 gyms. They've put out a target saying they're going to get to 450 gyms by 2025. Now, if they do that, we think the share price will increase by about 4 to 5 times from here. So we're early investors in this company. It's one of our largest holdings in WAM Microcap. It's also in the small cap fund, WAM Capital. So we're very positive on this story longer term.
Yeah, so I'm fascinated in this because what's coming through clearly here is that you're heavily investing in the potential of a cyclical recovery. And I'm hearing about companies that Seven West Media, Viva, and like companies that have really been, how harshly dealt with the market. So I guess the question is, can you sometimes get this wrong? Have you made any mistakes in the last 12 months? I guess I'm asking you this, Oscar. Do you look at anything that you've done and think, oh yeah, well, we didn't quite get that right?
Oh, plenty. Like I can't. I think Tobias, there was a famous bit of work that was done on a fund manager over, it was very successful in outperforming the market over 30, 40 year period. And I think the analysis showed that they got 4 of their companies out of 10 right. The key there is getting the weighting in the portfolio right. And so I'll give you an example. Like Temple & Webster has been a fantastic company for us. And it was at a very large weighting in the portfolio. City Chic is another one. So I guess it's always managing the weight in the portfolio. Now, I could rattle off a whole host of names that we've blown up on, let's call it. We had an IPO yesterday that went down 30%. But it was the weighting in the portfolio was 0.6%. So I guess, we were a little bit uncertain on it when we bid into it. Unfortunately, it was an e-commerce company and the market changed. And so investors didn't warm to it. I mean, if I touched on it before, one of the big mistakes I made sort of managing the portfolio was we had a number of say, mining services companies in the portfolio for an extended period of time. And a number of these IPOs came around sort of in September and October, and we were positive the market, but we always like to keep a little bit of cash because who knows what might happen. And I ended up selling some of the stocks that were beaten up or were weak at that time to fund IPOs. Now, I'll give you an example, was Macca, which is a mining services company, which we now own again. I think I sold it at 78 cents and we're buying it back again at $1.10 2 months later. Like, it's just crazy. But the market changed. And I think, look, if you're thinking about our competitive advantage, like a lot of other funds would make mistakes like that and wouldn't buy back because they made a mistake. Like, we're willing, because we see a lot of companies, we know when the market's changed, we're very happy doing that. So while it was a mistake, we've reassessed things, things have changed, won a few contracts, and we're happy to buy it back. But that would be my main mistake in managing the portfolio. But Tobias, you've probably got a couple of blow-ups, no doubt, you can talk about.
Yeah, I think a couple is an understatement. I went back to look at our portfolio in February before COVID, and it's pretty painful. And I think the one that was extremely painful for me is there's a company called Resimac, which is a mortgage business. On very low PE. We did a lot of work on the business prior to COVID. We had a decent position, and effectively when COVID happened, we sold close to the bottom, and now the stock is higher than what it was. I think we did the right thing at the time, selling it initially, given it was a crazy environment and we just had to control risk within the portfolio. Risk control is very core to how we manage money. The lesson or the mistake is really not buying it back sooner and sort of at least ride the wave back up. So that's one that's really hurt me personally, sort of making that mistake.
Well, I got to say, personally, it's very refreshing to hear portfolio managers admit to mistakes and making quite a few. Now, you've clearly got a lot right because you've averaged 21.3% per annum since you set the microcap strategy up in 2017. So what I'm really gathering from this is, and I think you referenced this, Oscar, your portfolio construction is the key. You've got your conviction positions, you want to get them right. I don't know how many companies you have in your portfolio, but obviously it seems like there's a little bit of a tail to the portfolio there. So if you do get one wrong and it's a little bit speculative, you're hoping that your core positions are doing the job. Is that largely the way you guys look at it?
Absolutely. So I'll give you an example. Like Tobias saw Temple and Webster. It had a terrible IPO, and I think you saw it at 20 cents.
Yeah, 24.
Yeah, so 24 cents. So this would be in the end of 2017, I'm guessing. And I think we put in sort of a 0.25% position in the fund. And at the time, our fund would have been $150 million. So that's very, very small. We're talking $300,000. Now, we would do that because we think if they get it right, this thing could, really, really compound and really, really quickly. And then as we do more work, we get more conviction. We speak to competitors. We speak to, we could see that other retailers' online business was going very, very well. And then you sort of see them for the next result. They beat expectations. Okay, we'll buy a little bit more, get a bigger weighting. And then, it's through most of 2020, up until probably 2 months ago, that stock was around 2.5% to 3% of the portfolio. And, if we look at what it did from COVID, I think the low it got to was $2.50 and it went to $14. Now, you think, you guys are fantastic, all that sort of stuff. Now, we never sold enough at $14, and we're always selling the whole way up. But I think that's an example of a stock. You always, as Tobias said, you're always trying to manage your risk, and particularly with a speculative stock like that. But I think once you do all the work and you back yourself, then that's when you really get a decent weighting in a company.
And Tobias, we're seeing a flurry of IPOs at the moment. Is it, you both have referenced the IPOs. And so the pre-IPO, the IPO market, that's something that you guys take an active, you're actively looking or exploring?
Yeah, 100%. So, we've always had the flexibility to invest in the pre-IPO market, but historically we've avoided the space given, it is high risk because essentially you're investing in startup companies. I guess what's changed recently over the last 12 months actually is where more and more of these companies are actually looking for a fund, such as us, to invest a small amount of capital for a period of time before they IPO that sort of help them with their working capital. For most of the funds that commit capital at the pre-IPO stage, these funds would generally receive, a higher allocation in the company's IPO, which is very important, especially if the company is of very high quality. So participation in the pre-IPO market is one of the reasons why we recently raised $88 million to increase the size of the WAM Microcap Fund. So far we have 4 pre-IPO investments within the fund. It's only 2% of the fund, so it's, we're very wary of making sure the exposure is small, but we are in there, so we get the opportunity to do research over a longer period of time and get a much better allocation if the capital raise in the IPO is a hot one.
So we're nearly out of time. I'm going to ask one last question. I'm going to get you to get your crystal ball out. So we've had a very strong period in microcap investing in the last 6 months of return. What's your outlook? Could there be another bootleg up in returns? Could there be a particular driver that could see microcaps continue to do very well? I'm asking you, Oscar.
Yeah, I think we've touched on it in the conversation, but we're very positive the market, at least I think from the next 6 to 12 months. I think what we're seeing is just this ridiculous dynamic that, money is free at the moment almost. Interest rates are at record lows. So I think, you can see it with the positioning in our portfolio. We like companies that potentially could acquire other businesses. And, we see like a company like Viva Leisure as an example where that could be a big business very, very quickly. So that's how we've positioned the portfolio, particularly in our big holdings. We do see a flurry of M&A activity in 2021. And look, sectors, say, for instance, we've done very well out of, such as retail over the last 12 months, while, everyone's worried about looking forward and looking into that June quarter or September quarter next year and saying, how are these companies going to keep growing? I think what people have forgotten is they have an incredibly strong balance sheet. A lot of these companies have no debt. They've all got cash. So there is an ability for these businesses to make acquisitions. So I think that would be our view. I do think that the technology sector will struggle over the next 12 months. It's had an enormous run for a number of years, but there is a number of beaten up cyclical companies. As you get people more out and about, willing to spend money, that should do well over this period. And we also think resources is going to do very well too. So I think sort of, if you looked at, I think shorter term, I think because it's had an almighty run, particularly in sort of industrial companies, I think probably the next 3 months or so will be, here or there. But once I think the news starts and acquisitions come through, I think that'll be the second wave. And I can't believe I'm talking second wave. Everyone's sick of saying things like that, but you'll see that. I think you'll have a very strong period for microcaps. So look, where our cash levels put in perspective are at around 11% in the fund, and as I said, back in March they were at 40. So that gives you an indication as to how positive we are sort of on the market at this point in time. Terrific,
guys. I found today fascinating. So on behalf of GFM and our clients, firstly, thank you for your time this morning. Secondly, thank you for the wonderful job you've done on behalf of our clients as investors in WAM Microcap, and congratulations on your performance. And most importantly, hope you both have a great Christmas and get a bit of a break over the new year. And we genuinely appreciate your time.
Well, thanks, Paul, and appreciate everyone on the call today. So that was fantastic, and I hope everyone has a good Christmas and getting out and about. It's been tough old year.
Absolutely. Thank you, Tobias.
Cheers. Merry Christmas, everyone.
Thank you. Merry Christmas.